Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with Tucker Allen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. This week we're going to continue a talk about money. We're pretty confident you don't tire of that topic, but we wanted to specifically deal with the issues that probably arise most commonly in your day-to-day interactions with people around you who are handling investments for you, maybe things you're seeing on television, radio, but recurrent phrases, terminology, options that I'm willing to bet that more than half of you don't know or understand, and yet you're hearing these phrases and these options for your portfolio all the time. So we want to dig down to some of the basics of sound investing. And in the process, we'll talk about how you can best manage your money as well. So who better to go to than somebody from Moneta? Used to be Moneta Group. Some of you would know it as that, but Moneta is, I think without question, the largest financial advisory group
right.
in the St. Louis, maybe Missouri area.
Right.
And we'll get a little more information. We have with us Travis Freeman. Travis is a financial planner, right? He works.
That's right. He
full-time works with Moneta. And a little more context with Moneta. Moneta manages investments for people. And I would say many of your investors probably have a little more money than less. Would you say? Yeah,
That's
probably
correct, yeah.
Mostly are above middle class or upper middle and above. Is that fair to say?
Our typical client is affluent.
Yeah, affluent. So, and the amount of money that you guys manage, I've seen you listed in Wall Street Journal compiles annually a list of the largest money management firms in the country. And Moneta always makes the list. I don't know where you are on it, but I noticed that I think you were the largest, certainly in Missouri, in terms of assets under management. Could that be true?
One of the largest. And if you think about it, there are many different facets of the industry. You have brokerage firms and then fee-only firms. So in the fee-only space, yes.
Yeah.
Barron's has us in the top 10 in the country, which is pretty neat.
And
That's
how long
it.
has Moneta been around? Can you give us a little history?
So I merged my practice in there in 2018, and I'm a partner today with about 50 other people. And I didn't know this until we started kicking the tires with each other, but Moneta's been around for about 150 years in St. Louis.
Wow.
A little longer than 150 years. The roots go back that far. Now,
didn't
it
know
looks
that.
a lot different today than it did back then.
Sure.
And a lot of people don't know that. Now we're a national firm. So for about 150 years, we were in St. Louis. Now it's St. Louis, Denver, Boston, and Kansas City.
Okay.
Wow. And you can manage money for anyone in the United States.
That's right. Yeah, we have clients in just about every state. I even have I'm talking to a client in Alaska next week.
Really?
So let's explain a little bit of this, of these terms. Like you said, fee only versus, for example, what a brokerage firm might do. Explain for a minute the difference between Moneta and, say, Payne Weber or another brokerage firm.
Oh, great question, Joe. So fee only essentially means that we don't accept commissions of any kind. The finance industry has two primary divisions. So you have the brokerage world or the broker-dealer world, and then you have the investment advisor world. So, and to make it a little more confusing, some financial planners have a leg in both courts, so they can wear either hat. What that means is that on the brokerage side, that's the ability to sell products and earn a commission. Whereas the investment advisor side, typically that's a percentage or flat fee, similar to the way an attorney might charge for their services for advice, right? And some professionals are hybrids where they could sell commissions or they could charge a fee, even though sometimes I think if you ask someone, hey, are you a fee-based financial planner? They'll say fee-based. But I think your listeners will really enjoy knowing this. Fee-based is very different than fee-only. It's easy for someone that is a hybrid to say that they're fee-based, but it's a little tricky because fee only means you don't accept insurance commissions. You have no insurance license. It means you do not belong to a brokerage firm or a broker-dealer. The only way you are compensated for your services is through a transparent fee.
So what are the benefits to the consumer if you're fee-based, fee-only versus commission?
Sure. So think about this, Jill. If you were to help, let's say, a family member meet a financial planner, let's say they received a settlement of some kind, and you're interviewing some professionals, and you meet someone that you really like, very personable, seems trustworthy, great credentials, but it turns out that this person can charge commissions on complex investments or charge a fee. If your family member winds up in complex investments that paid commissions, and then 5 years later, there's another recommendation to switch it, is that really in that person's best interest, or is this person trying to earn another commission? I don't know what the answer is. If someone's with a fee-only professional, there isn't the commission. There's no churning opportunities, for example. The fee is the fee is the fee.
So you pay that one time, right?
So typically, investment advisors will have a percentage fee of 1% or less, and it's that same fee on an annual basis. So if there's a recommendation to change something, it isn't to line that person's pocket. The fee remains the same.
Right.
And that's the troubling incentive that we've talked about on this show before, that whenever you have a traditional commission-based financial advisor, you have to wonder whenever they call you at a given time and say, we should sell this stock or this fund and buy something else, because that's the only way they get paid. And that means that if they don't have activity, you call it churning. Churning, I guess, is the harsh word that's used to describe this process, and it means simply activity for activity's sake, because that's how you get a commission. You sell something and buy something else. Mm-hmm. So those of you who have portfolios where there seems to be lots of activity and you thought, gee, that's a wonderful thing, shows they're really paying attention to my account. Well, they are paying attention to your account, but the activity could very well be the basis for generating fees. Now, I don't want to be, or commissions, I don't want to be harsh and generalize too broadly. Obviously, they're very ethical. There are ethical brokers, and I don't mean to suggest there are not. But the point is the incentives are wrong. And that's the thing about the legal profession, and I would argue financial advisory profession, financial planning profession too. Have they been pretty conscientious about trying to create the right incentives? So some professions try to have rules in place ethically to not tempt people, to not tempt their professionals to do things that are not beneficial to the client. But when you have something that's commission-based, it can also mean if you're having a product recommended. I mean, that's a big piece of it. As a matter of fact, for some of these commission-based planners or advisors, really, I would bet that maybe in excess of 80% of their income actually comes from the products that they sell, which an annuity, what do you have any idea what the fee is on an annuity, what a commission would be?
Yeah,
it's huge.
So annuities, right? Complicated investments. I've met some financial professionals that didn't quite understand them because they are very, very complicated.
Yeah.
But if someone purchases an annuity, today there are fee-based annuities. So this isn't be annuity bashing or anything. And by the way, I probably should mention that any opinions I give today reflect just my own and not that of my partners or my firm.
Moneta.
You
I understand.
But with these annuities, the commissions can be anywhere from, let's say, a 5% up front with 1% a year for a period of time. Some of them are 7% or higher up front. So imagine this, someone is sold an annuity, doesn't mean I'm not saying it's bad, doesn't mean the person's bad, it's just a matter of fact. They get into it and upfront commission's generated. There's usually a surrender schedule, and some people don't know about this because it's on page 82 of a 200-page booklet, right?
And who's going to read all through that?
Yeah, very few people do, right?
Including your advisor.
Yeah.
Right, yeah, I've seen some of that. So they're in this product, there's a 7-year surrender schedule where if they try to get out early, there's a surrender penalty. Then 7 years later, they get a phone call, hey, I think we should switch to something else. It's possible there is something better out there to switch to, or is it an opportunity to generate another commission? And that's just where a lot of deep questions need to be asked. And it doesn't mean that you're being rude to this professional. It's just business. You're asking questions because this is your hard-earned money. You have to ask the question.
Well, and you have to know that they do have your best interest at heart. And, that brings me to my next question. Say a friend recommends their financial planner, but you still want to do your homework. of course. You just don't want to take your friend's word for it because maybe your friend isn't as well versed on financial planning as they may think. So how can a consumer go out there and do the research?
Sure. Well, luckily, it's fairly easy to look up the backgrounds of financial planners these days, and I find that many people aren't aware of these regulatory
And we're
websites.
not talking on Missouri CaseNet.
Right, yeah, you got it. You can certainly look up CaseNet, right?
Yeah.
But so there are two regulatory websites that have these disclosure sites. FINRA, FINRA, and that's called the Broker Check website, and the SEC, the Federal Securities and Exchange Commission. So why do two websites exist? FINRA regulates brokers and broker-dealers, and the SEC regulates investment advisors. If someone's a hybrid and they have licenses to operate either by commission or fee, they're going to wind up on both sites. But don't worry, if you go to the wrong site, they connect, so it'll send you to the other one.
So let's then make clear what I think you agree with me. What is an alternative to what we've been describing? We talked about commissions, where based on each transaction you pay a fee, or percentage maybe of the amount of the transaction. So no transactions, your advisor wouldn't get paid. Similar thing with selling products. So the alternative to that is somebody who is a fee only that bills on an hourly basis. Now that's often like a certified financial planner. And I'm interested how you guys do this, but so a certified financial planner may tell you, yeah, I'm not going to buy and sell your products for you, or by products I mean like insurance or annuities, things such as that, or I'm not going to actually buy and sell stocks for you, but I will do an analysis of your financial plan. I'll make recommendations to you and look at your large picture financially, including your insurance, your retirement plans, what else, your tax planning, all that stuff. So that's kind of a traditional CFP, Certified Financial Planner. And more often than not, they're paid based on an hourly basis, maybe a flat fee where they'll say, I'll do your planning for $1,000, and they'll develop a plan for you. And then there are others who would be kind of investment or money managers, and you guys I know fall in this category. Whether or not the first one we'll see, but that's where somebody says, yeah, I charge you a percent of the amount of money you're giving me to invest. So if you give them $1 million, they'll have a fee schedule. So at $1 million, it may be 1%, maybe 2%, but it's a percentage. So they have no incentive to engage in activity, moving stuff around just for, as you said a few moments ago, just for the sake of it. Instead, if they do that, they probably think it's a good idea for you financially, because the more money you make, the more money that the planner makes. It's a percent.
Right.
So tell me how your fee schedules work.
Yeah, so you are correct that generally fee schedules will start at 1%, and as someone has larger and larger amounts of wealth, it will decline, right? Sort of the opposite of our graduated tax system that we have. Now, on the flat financial planning side, that is something that we do. In fact, it's funny you say that, Joe. So obviously we met because of a TV interview, and I've published a book, and I have YouTube videos and things. I was contacted by a gentleman a couple months ago out of Des Moines. Never met the guy. We have no connections. He just said, hey, I saw your materials online, and I'd love to chat. Never worked with a financial planner before. He said, I kind of like managing my own money, but I just want you to help me figure out the complicated things I don't have time to figure out.
Right.
It was a flat fee. Right? A lot of people don't like the hourly part, at least in our world, so we had a flat fee. And we're still speaking, but this is his opportunity to say, do I want them to help me implement all these things we've now analyzed, or do I want to go do it on my own because I have a roadmap to do it? And we did not give away the time. We charged a fair fee, and if he wants to do it on his own, that's great.
So you put together a plan for him and gave him recommendations, et cetera. And then it's up to him whether he wants to do it. So if he uses you, then he gives you all the money, and you'll collect maybe a percent, maybe 1% based on the amount of money he gives you. And he would pay that every year.
That's correct.
That's an annual fee. And so if you turn $1 million into $2 million, it's a win-win. Your 1% now is 50 or 100% more than it would have been if you hadn't grown the money. Now, are you a CFP?
Yes.
Okay. So I've talked on the show before that I'm a fan of certified financial planners because I think that it's a pretty rigorous training process and et cetera. So do you maybe the example you gave us is an example of that, but let me just ask you differently. So if somebody contacts you and says, I don't have a plan at all in my life. My wife and I, we earn decent income, but gee, I'm not sure whether our insurance is all in place. Do we have the insurance we properly need? And I have a CPA, but I don't know that our tax planning is as good as it should be. We're trying to decide with Social Security, when should we take it? And what about my 401k on the job? Should I go ahead and move that to an IRA? Just a look in 360 degrees of their financial life. And that's what a certified financial planner is capable of doing, correct?
That's correct.
And now, do you charge a flat fee for that?
Mm-hmm. Generally, we do, yes. Yeah, it depends on the scope and how much time is involved. If someone wants something basic and they're just trying to determine if we're the firm for them and we like them and there's chemistry, then we might do some things pro bono. But yeah, you described it very well. It's about a 360-degree view comprehensively of everything that they're dealing with.
So, granted, as you said a while ago, and I knew this when we had you on, that you guys really, to use your word, you target the affluent. But I still know, because of the quality of your reputation, that what you had to say is beneficial to all of our listeners, many of whom cannot afford to use perhaps Moneta. They wouldn't consider themselves affluent. So in a way, it kind of makes you real objective, too. But tell me then, what are those thresholds? What is the point at which it makes sense for someone to use Moneta versus another firm?
Sure. So generally speaking, and again, this is other folks at the firm might have a slightly different spin on this, but generally speaking, if somebody has at least $1 million, generally we can work with them. Now, certainly if someone is a client and they have children, we're not going to tell the children to go away just because they don't have $1 million yet. And there certainly are exceptions, right? Anybody at Moneta reserves the right to have an exception to that. But most of our clients have in excess of that. Now, keep in mind, though, I enjoy doing stuff like this with both of you because we're able to talk to people regardless of what their wealth is. The fact that we can share our wealth of knowledge and help people regardless of their means is a lot of fun. It's actually the next book I'm working on is meant for 20s and 30-somethings.
Okay.
And those are not the type of folks we usually serve. But guess what? If I have the ability to help people understand the strategies they can do when they're young and they have the time to become independently wealthy one day for all the good reasons that they have, that's fun.
Now, do you have any clients that are not affluent, but maybe more upper middle class?
She's wondering if you represent any poor people.
So two things. Well, one, I do pro bono work, and there are other folks at the firm that do pro bono work to help and give back, and it's what we need to do as an industry, in my opinion.
That's great.
But secondly, there are what I call the millionaires in the making, where they might own a business, they're doing really well, the business is worth multiple seven figures, but they just don't have a lot of liquid assets yet. That might be somebody we're going to help. It's all in the business. You got it. And maybe that business sells one day, and we're helping them for the next 5 years to plan. But there are people, to keep it short, Jill, there are certainly people that we help without an expectation of them having $5 million for us to manage.
And I have to ask you something, and I'm just fascinated by this, even though I really don't understand it. What do you think about Bitcoin?
Bitcoin, yes. So Bitcoin and the other roughly 400 cryptocurrencies that are out there today, I think cryptocurrencies are here to stay. They have shown that there is enough market demand, both in the corporate world as well as the retail investor side, that they're here to stay. But what's likely to happen is that the Federal Reserve Bank is going to adopt the technology that cryptocurrencies are built upon and operate from, to have a crypto version of the U.S. dollar that the Federal Reserve Bank can control and regulate a little bit more. That is my prediction.
But do you recommend to any of your clients investing?
No. I have a lot of people who ask me about it, and I'll tell you the same answer I tell them. Go ahead and put some money into it if you really want to have some fun. Full disclosure, I have put some money in 4 different cryptos just to have some fun with it and educate myself.
Yeah.
But this is money that I'm willing to part with and never see again, because at the end of the day, it's a commodity. And in fact, that's what the IRS has deemed cryptocurrencies to be, are commodities, in the same way that gold, platinum, silver, palladium, and coffee beans are. commodities, right? They don't pay income. They're there based on supply and demand purely. And when you have that kind of a way to value it, you're going to have wild swings at times.
But it's a commodity without any utility.
Right.
You know, it's, I don't know. I'm very skeptical. And I've said that on this show before, that I just think between the inevitability that governments are going to regulate the heck out of it, the idea that you can engage in these transactions without the government reaching in and forbidding it, and they can. I mean, one legislative swoop would wipe out 99% of the people who use it. You always have this 1 or 2% that will ignore the law, like tax laws. You have some percent who are just defiant about tax laws. The rest of the world, maybe it's not 99%, but a good 90+% are going to be very, very conscious of tax laws, and they're not going to want to risk prison or all the other bad things that happen when you get on the wrong side of a government when it comes to taxing. I think it's the same. It'll be the same issue with crypto. So China's reached it. It got fed up very fast.
Right.
You know?
Yeah.
Some initial rumblings from China was that they were going to be kind of receptive to it. And people thought, wow, this is great. So crypto goes up 10% or something 4 or 5 months ago. But then China suddenly announces, as anyone knew they would do, the idea they're going to let anybody engage in a transaction that they don't know every detail of.
Right.
I mean, you talk about a totalitarian government. I mean, they know how many stop signs you ran. They know whether you've jaywalked. I mean, they have those cameras everywhere, and you're rated as a citizen based on your compliance with these rules, and you get benefits as a citizen. And the idea that crypto would allow it to run muck,
that doesn't make sense.
But the U.S., the EU, I mean, it's all coming that they're going to all have their own rules. They're going to forbid it. And apart from that, even if they didn't forbid it, as you pointed out, 400 of them. So what's sacred about, you know, any particular crypto like Bitcoin? I mean, what's sacred about it? If somebody else can come along and do the same thing, you can at least say that gold and silver, which I consider kind of old world alternatives, I mean, they've proven their worth over, you know, millennia, and there's a consensus about them, and so I don't think they're going away. No. But anyway, so you and I are of the same opinion about crypto.
For sure.
But we'll see. One thing, it'll never be simply a currency because the price swing is too wild. Right.
And I've never met anyone who's actually spent it on anything. You know, Tesla came out or Elon Musk, I should say, came out and said Tesla was going to allow it to buy vehicles and then changed his mind. And imagine if somebody would have put $1,000 into Bitcoin and it turned into $100,000. If you then sell that Bitcoin to use it to buy a Tesla, you owe taxes on your gain. Right? Yeah. It's an impediment to actually use the currency to buy anything. So anyway, not to capitalize the conversation on that, but I think it's here to stay. It's going to change a lot, and I think governments will have their own.
Yeah, I think it's here to stay as a government, as authorized or approved currency. But I want to hit on a couple of things that I think are common questions people have about financial planning. And for some of you watching, these will seem very basic. Others will know a little bit about it, but maybe you'll still learn a little bit. And then others will have heard the phrases and always wondered what's involved. So we'll kind of go through these a little as quickly as we can and be helpful. One thing I wanted to talk about was ETFs versus mutual funds. I mean, how often has that come up? You don't hear the phrase mutual funds as often anymore. Used to, you know, it dominated all conversations. The issue wasn't what stock you buy. The issue was what mutual fund. And you might give a little bit of history. I'm not asking for details. This all, incidentally, as a disclaimer here, Travis had no notice of what we're going to talk about, so there's no preparation on these topics I'm throwing at him. But give us a little bit of the history of mutual funds and how ETFs have come along and why they seem to be more popular if they are.
No doubt. There's been a proliferation of the ETF. So mutual funds, in essence, right, a basket of investments managed by a portfolio manager, right? Someone's at the helm with a team of really intelligent people day-to-day determining what they're going to buy and sell. And there's a mandate, right? Large companies or international companies or bonds. So to pay that manager and that manager's team to do that, there's an expense to it, typically as a percentage called an expense ratio, which you can find generally online at Morningstar or Yahoo Finance. Well, then exchange-traded funds came out, and they were essentially the same concept, a basket of securities where you could get broad diversification by buying one investment. However, generally speaking, there's no portfolio manager. It's typically a static basket of investments, and you pick the flavor that you want. Large companies, U.S. companies, bonds. You could even buy commodity ETFs. There are cryptocurrency ETFs coming out. So what are the differences? If you like more active management, and personally, I'm a fan of ETFs. I'm also a fan of mutual funds. It depends on what you're getting into. If this is a municipal bond pool of investments, I don't want to just own any 200 municipal bonds. I want a portfolio manager because it's a very niche area that's going to pick and choose what to have. If it's U.S. large company stock, I'm probably going to buy an ETF. And by the way, this is what I've done in my own portfolio. So it really just depends. But I'm a fan of both. And ETFs generally are less expensive than mutual funds because there isn't, a manager day-to-day doing everything.
So the costs are lower.
Costs are lower, you got it. And
so is that the reason they're not as popular as they once were? Because of the costs compared to ETFs?
I think that's a big part of it, Jill. I think a lot of people gravitated to ETFs for certain areas of the market to gain exposure. Less costly, you can trade them during the day like a stock. Whereas mutual funds, many people don't know this, mutual funds only trade one time at the end of the market day. So if the markets are volatile like they were last March because of COVID, and you don't want to wait till, at the end of the day to get out, you want to get out at 9 a.m., an ETF can do that where a mutual fund is redeemed at the end of the day.
I didn't know that.
It doesn't mean one is better than the other. They are just different animals, and I have both in my own portfolio.
Okay.
So, so if you are comfortable with buying a list of stocks and just keeping that same list, not have somebody prune it daily, go through and decide, oh, this isn't a good one anymore. Let's sell this one and buy a new one. If you just want that picture, that list of stocks held together, then an ETF does that, and it's cheap to do it.
You got it.
And the mutual fund is where someone is actively trading those. That they'll sell some and buy others. It's interesting that used to you didn't hear about ETFs at all, and now they've gained a certain popularity. So with mutual funds, the taxation's a little different too, isn't it?
Yeah, in a mutual fund, and this can happen in ETFs as well. In a mutual fund, if there are 100 stocks owned inside of it, you open the hood and see 100 stocks. If that portfolio manager decides, you know what, we've owned Tesla, Facebook, Netflix, Amazon, and these have gone way up, we want to sell some, gains are then realized at the fund level for all the, let's say, hundreds of thousands of people in the fund. By the end of the year, if that fund has net gains, not net losses, those gains can then be passed on to all the investors via that great 1099 that you might get at the end of the year. Whereas an ETF, generally you're buying a static basket of 100. They're not being bought and sold for the most part, and there may not be a 1099 at all unless you yourself sold the ETF. So there are some tax nuances to understand there.
Yeah.
And I think there's a phenomenon where you can actually have mutual funds that their liquidation value, their net asset value is less, or I guess theoretically more than simply the total of the assets minus the liabilities.
And you can have that in ETFs too, but now we're getting into arbitrage. Don't get me started on arbitrage.
We're going too far down the road. Okay, sorry.
You're good.
No, you've told us enough to answer that question. So let's talk a little bit about GameStop. The whole thing with Robinhood, Wall Street Bets, which is that group, I think that's what they're called, Wall Street Bets, a group of people who are actively engaged in these transactions throughout the day, some of whom have made hundreds of thousands, if not a few million bucks, some of whom have gone broke.
Right.
But so talk about, what are your thoughts of this phenomenon? And we can start with GameStop, the particular stock that this crowd just hovered around and adopted, and it became this cause celeb for this group. And for reasons that the rest of the investment world, the experienced, tired investors that you see on the talk shows, they don't get it at all.
Doesn't it really appeal to the younger people? Is that true?
It's very driven by young, isn't it?
Yeah, this was for sure, for certain. So, again, this shows and exemplifies the power of social media. So GameStop, right, publicly traded company, but not doing well financially, according to many analysts. So you had some large institutional investors and hedge fund managers saying, we don't think the stock's going to do well, we think it's going to go down. So they decide to short sell it, which essentially means that you can have a transaction where if the stock does go down, you actually make money. And by the way, if anybody wants to understand more of this, you can watch a show called Billions if you subscribe to Amazon Prime. Fascinating show.
The name of the show is Billions?
It's called Billions, yes. And it's about a hedge fund manager. I'm actually watching that on the treadmill. I've been watching it on the treadmill recently. It's a pretty neat show.
Is it a documentary or it's
it's a Hollywood show.
Okay,
yeah, and there are Hollywood effects, but there is some educational value to it. I'll say that. Just don't let the kids see it. So when it comes to GameStop, then a lot of these. I don't want to generalize the term, but a lot of these young folks or the people that were in this group, Wall Street Bets, had said, we don't like the idea of GameStop, which they were fond of, going down and then someone making millions of dollars on the backs of that decline. So they decided to squeeze the short sellers, drive that price the other direction up, right, the way that the hedge fund manager didn't want it to go, and that forces them to lose money. There's a complicated reason for that, but that's essentially what happened. Now, we all saw that play out in the news. GameStop is a company many people didn't know, and everybody in the country knew it. And that happened with a number of other stocks after that. But that just goes to show a phenomenon that really had never occurred before this. And that was the power of social media and crowds to grab onto a story. Yeah. And even though people knew they might be putting their $100 or $500 in there and completely lose it, they wanted to prove a point. And for the most part, they did.
But what's strange about it is you would think that would wind itself out and then the market would, or the stock would return to what the experts say is the market value, looking at the financials. But instead, it comes down and then it shoots back up and hovers up there. Isn't it still above 200 or it's way up there now, I think.
I haven't seen it in a while, frankly.
Okay, I think it's still way up there. So it just puzzles me how it can persist in holding a value that the market up to that point had said there's no justification for, and many would still say there's no justification for, just by the sheer determination of this group.
Right. And now there's enough popularity and enough speculation on it to possibly continue to drive that type of demand, right? Unless something really horrible happens to the company, and I hope that doesn't happen. But I think that's one of the reasons that you continue to see that kind of volatility with that stock. A lot of eyeballs on it still.
Yeah, and like you said, the power of social media. It drives everything, it seems.
And so I think you could say this about the phenomenon is that you have a group of 20-somethings who are rejecting a lot of the traditional valuations of stocks and who appear to be on a mission of sorts.
Rebel investors.
Right.
Yeah, they reject the status quo. They reject conventional wisdom, conventional stock valuation techniques, apparently, and they collectively almost go for particular stocks. AMC is another one that has been on a binge, and despite the fact that their financials looked really poor, now they're way up there in the hundreds, far above where they were. Hundreds of percent appreciation in just this year. It's amazing.
It's fascinating. You're right.
So you're not recommending that our audience, who incidentally I assume all of them are above 65. This is probably not a game they want to put their retirement funds in.
I would not recommend buying GameStop for now. It doesn't mean you don't need to, but watch out for speculation and popularity. I remember when hydrogen vehicles were popular, and then everyone wanted to get into solar. And there is always a fad. Every single year there is a fad, and my answer seems to be the exact same. I just fill in the blank of whatever the fad is.
Yeah. and it's always steer clear.
Right.
Yeah. So let me ask you a couple other topics. Everyone's concerned about inflation, and there are inflation-protected options that are available through the Treasury, I think. So if you would, talk a little bit about what you're telling your clients on the subject of inflation, what they might consider, and do it in the context, though, especially your clients who are older, to the extent that varies, and I can see where it might vary. Just viewing it from the standpoint of your clients who are older, talk a little bit about inflation and then talk about some suggested options for them.
It's interesting you say that. I was having dinner with my father over the weekend, and he had brought up inflation, right? He's concerned about it. And we talked about why. Inflation is a necessary and healthy part of an economy. We have to have inflation because if we had the opposite, if we had deflation, Jill, if you needed a new car and you knew the price of that car would be lower a year from now, you're not going to buy it. So imagine if everyone froze up and didn't purchase anything, it wouldn't be good for the economy. We need inflation. That's how people get raises, et cetera.
Sure.
Well, the Federal Reserve Bank is targeting a rate of 2%. That's what they want, a controlled level amount of around 2% a year. If we have inflation that is higher than that, what does that mean? I really see this in two courts. Some people can benefit from inflation, and some people would not benefit from inflation. Who would benefit? If you have assets that generally increase when inflation increases, such as real estate, so if you own your home or you have rental property, you probably welcome inflation. You want prices to go up because you're going to directly correlate
Well, that's
with
what's
that.
happening right now with the housing market. It's a seller's market.
Right. All this money gets pumped into the system. It creates more demand. It does devalue the currency. And then all of a sudden, because of that increased demand, prices are going up, right? You're seeing it. That's a great example.
And those with fixed long-term debt,
right?
You would include.
You got it.
Much of it real estate related.
Yeah, so you're correct. So real estate is obviously an asset that would be good for inflation. It would increase with it. If you have stocks that can increase the prices they charge for their goods or services, that generally is a good hedge against inflation. So who am I worried about with inflation that's higher than what the Federal Reserve wants? Two examples: folks that don't have any of those assets. People in our country that are struggling and making minimum wage or just above that don't have any assets that might increase with inflation. I do worry about that. Especially if we're not going to have the same inflation in their wages, it's just the price of groceries and gas and everything goes up, but not necessarily the wages. That worries me. Not good for an economy. What else worries me? If people are keeping a lot of cash on hand, they have a lot of CDs or money market accounts or a lot of bonds and fixed income, those assets will get deteriorated as inflation increases. So I call that the investment moonwalk, right? You might be earning 1% on a 5-year CD, but if inflation's at 2.5 or 3, the bank isn't going to tell you we lost money this month, but in the back of our minds, we have to remember that, right? It's devaluing and deteriorating our purchasing power.
Yeah, and I think that many people assume that the stock market will appreciate just like real estate. And in this early inflationary period that we've seen this year, it's true that the stock market has kind of gone up, which, as you pointed out, there are particular companies that they have products that they have pricing power and they have the ability to simply increase the price as they need to. So those will keep pace with inflation. But I think if we look, tell me if you agree that if we look at how stock markets have done during double-digit inflationary times, stock markets have not done well overall. Would you agree with that? Like in the 70s? Not that you were around the 70s.
I was around in the 80s. So, if anybody remembers in the 80s having a mortgage at 15%, and that was a good deal back then, right? High inflationary period of time. The markets also did fairly well during that period of time. 70s, a little more volatility. So I think it really just depends on other factors that are around besides just the inflationary one.
So how long do you think this is going to go on with the housing market? Do you think eventually, it's going to go back to being a buyer's market?
I don't think we're going to have an 07, 08 event, right?
Yeah.
But eventually, yes, the market will come back to equilibrium because you can't have, in other words, do I think we're going to have people in bidding wars for homes that just went on the market, a day earlier? I don't think 3 or 4 years from now we're going to continue to have that.
Okay, because that's what we're
leads to
seeing a lot
bubbles.
now is those bidding wars.
Right, I know. Eventually, it will. The free market comes back to equilibrium, and I believe that will happen.
Okay.
Yeah, and I want to get your comment too on these, which is a related question, these supply chains where I think the Fed's position is that we shouldn't worry about this inflation because it's really just temporary because it's the result of trying to catch up with this sudden consumer demand. And so it naturally, all of these commodities providers, miners and other resources, even factories, weren't ready for this sudden, influx of orders. So they're scurrying to get these supplies for purposes of the next user, much of it other manufacturing. So their argument sounds reasonable, doesn't it? It sounds like, well, okay, so there is a supply chain shock or crisis. And, once we give, these sources time, they'll generate enough to meet the demand and prices will. But who was it that said? Bill Ackman of, what is he with? Pershing Square.
I think that's right.
Yeah, Bill Ackman, this highly respected financial advisor who's made a ton of money. But he said it's hard to characterize inflation as temporary when once you've seen the increase happen, it's not going back. He talked about wages, for example, that the increases that have occurred in the last 3 months. I mean, now any respectable employer almost, certainly the nationals, are now up to $15 an hour.
Right.
I mean, it happened that fast. And his point is that's not going to be rolled back.
Right.
But my thought in response to that was, but inflation is a continuing cycle.
You got
exactly.
that, Joe.
So
Yeah.
comment about this.
Absolutely. So I think a great example that anybody can relate to is what's going on in the automobile industry right now. My wife and I actually went through this. So we needed to replace her vehicle. I called up a client of mine who owns an auto dealership in St. Louis, and I won't name who it is, but it's good to have those friends.
Sure.
And I said, hey, can you help us replace this vehicle? He said, yeah. He started searching nationally to bring in the car that we wanted, and nothing too crazy or fancy, and it was taking months.
Because of the chip shortage?
You got it, the computer
Yeah.
chip shortage. And he said, hey, Travis, I got to tell you, I don't think we're going to find the car that keeps getting gobbled up because you want a car that's 2 years old roughly, and because automakers can't create new vehicles because of the computer chip shortage,
Right.
what does that do? If you can't get a brand new car and your car just broke down, you're going to get a car that's 1 or 2 years old. So what happened was there was about a 10 to 20% increase depending on the type of car. And I did the math and said, well, it makes more sense just to fix the repairs we had and give it another 2 years in the vehicle. And that is a great example of this short-term period of time because of supply chain issues that increases the rate of inflation on vehicles. And it's happening not just there, it's happening in many areas.
So I guess the question becomes, and a lot of people think that inflation is really about material things moving around, but economists have talked about inflation really being a state of mind in that it's really a matter of perception, is that if you have a consumer that believes that inflation's going to occur, then you will have a self-fulfilling prophecy because a chain of events will be set in motion. Simultaneously, as we've seen, if you have a consumer that does not believe that there will be inflation, you can have a Fed generate lots of new money and you won't see much, if any, inflation. Now, it helps that there's been no spending of money. So I was making the point the other day to someone that said, "Oh, inflation is a direct result of the supply of money," and I think that's a quote from Milton Friedman, a Nobel Prize winner. So you have to be careful when you start to disagree with Milton Friedman.
Right.
But think of it this way: you have $1 million in circulation. And so you print another $1 million and you distribute it. And let's assume it goes to a certain number of people, say 10% of the economy. So they take that additional $1 million, let's assume, and put it under the mattress, just to make a point of illustration here. So would you have inflation then? And I think the answer would be no, unless it were a psychological phenomenon, meaning people can simply go out and you could have sellers raise prices in the absence of additional money. I mean, you could have that happen based on an expectation. But I use that silly example to establish that it simply is a fact that increasing the supply of money does not mean that you have an increase in prices. That simple illustration, everyone would agree, yes, it would be possible to have $2 million printed and prices be unaffected.
Right. Yeah, and I like the putting it under the mattress example because I think you're alluding to the money multiplier effect where they put it in the bank and then the bank loans it and then someone else puts it in their bank and that bank loans it, right? So $1 million goes in, but it's more like $8 million that goes into the system. But yes, hypothetically, it all goes in the mattress, never enters the system, assuming someone doesn't feel wealthier and feel like they have more disposable income. I think you're accurate there.
Yeah, and even if we take a more real-world example and say they do put it in the bank, I mean, if you don't have businesses that are going in and borrowing that money in order to create that opportunity to multiply the dollars, then you still have the same problem. You know, it's gotten into the pipeline, but then it's stuck in the pipeline. And I think that's the reason you have negative interest rates in Europe is an effort to, you know, it's like pulling out a whip to flog people to spend money.
Right.
And they say, fine, if you don't spend it, you have to pay us money for the privilege of not spending it.
Yeah.
So that you would think with that everyone would say, fine, I'll spend it. But in fact, many of them pay like 3%, 2%. They actually pay this penalty in order to say, look, I don't want to spend it and I'm willing to pay money so I don't have to.
Yeah, for the safety of keeping it in the bank despite losing the money. Yes, it's fascinating.
It really is.
I'd never heard of negative interest rates until the last 10 years or so. So anyway, I think inflation is a fascinating topic and no one has a crystal ball. We'll see what happens. What was I? Paying someone to manage your money. Okay, we talked a little bit about that. I think that people are pretty clear on that. And we wrap up. Is there any topic that we should wrap up with here to be sure that?
Well, you know what I want to know? This all is very complicated, especially with someone that doesn't have the background that you do or that you do. So how does someone know that, you know, their investments are being managed well or looking for red flags that maybe they're not?
Sure.
That's a good question to close with.
Yeah, the red flags. And again, opinions are my own here. But at the beginning of the show, ironically, we were talking about annuities. And again, it doesn't mean annuities are bad. Some of them are fee-based, and I'm a fan of them. Some of them are rife with the potential for conflicts of interest and commissions. A red flag would be if a listener or a listener's family members, especially for someone that might be in their 70s or 80s or higher, where there's a potential for elder financial abuse, which is real. If somebody is in a complex product that has a period of time that they have to be in it, it's possible there was an upfront commission generated and they have to be in there for a period of time for that insurance company or the investment company to make the money back that they paid as a commission.
Okay.
Then as soon as it's over and they're able to get out without a penalty, someone recommends another one similar. Is that in their best interest? It's possible. Are they trying to get another commission generated? It's possible. And in those situations, that person or that person's family member, maybe it's their durable financial power of attorney because they have their ducks in a row there, you know, and I'm always a fan of getting all that done. Someone needs to come in there and ask very pointed professional questions just to make sure nothing's going on, because I once met someone who was roughly 85 years old. She lived in Florida, and she was sold a 10-year surrender period annuity. Now do the math. She was around 85.
Oh, my goodness.
10 years, she couldn't get the money back out. And she had no idea. It's possible she was told and she didn't remember, but she had no idea that she had to keep the money that long.
Wow.
Yeah, it's a shame.
That's unbelievable.
And not all people, not all of our listeners are real vulnerable because of their age, but I would say most of us, the older we get, the more vulnerable we are, no matter how sharp we might have been in our prime. And I think that older people especially have to be cautious to be sure that they're not. The same thing happens with permanent insurance. You might make reference to that, where, what's it called? There's now an ethical prohibition where they encourage you to give up insurance, permanent insurance to take out a new policy. The same reasoning you were describing regarding annuities. There's a phrase now the insurance industry has adopted to discourage, maybe they call it replacement. But anyway, because it was so common for people who sold these policies to, after they had collected this huge front-end commission, and people would be shocked to know how much on, for example, $1 million, call it $500,000 permanent policy. Again, I'm wrong on the numbers, but it could be easily like a $20,000, $30,000 on the front end as a commission. I mean, it's huge, whatever the exact number. And you don't have to pay that back unless somebody gives it up in the short term. But after a period of time, there's no clawback on that. So the commission is earned. Mm-hmm. And then often there's an incentive, sometimes by that same insurance salesman, to come in and say, you know what, that was a good idea then, but we need to do something different. But even if it's not them, and usually it's not them, usually it's somebody from down the road comes and now they come along, some new referral through your church or family or whoever it might have been, and now they're saying, you know, I'm looking at this. I don't know why you have this policy. That really wasn't a good idea. We need to replace that policy. So the insurance industry now has some very strict rules about that. I think that they have to notify the previous insurance salesman, but it still may be the industry protecting its own and not so much the consumer.
But if they go to a fiduciary, right, so a fee-only true fiduciary who isn't in both courts, right, that's all they do, that doesn't sell insurance, they can go and get an independent opinion, and if it looks like it does make sense to switch from one insurance policy to another or one annuity to another, right, they are essentially getting a prescription from the fee-based CFP that they can then fill with any insurance agent they want, right? I call that trust but verify. Take the recommendation from the insurance person, ask a fee-only fiduciary just to see, and if it's a solid one, they're going to tell you.
I mean, this is ideal advice, and we come back to this periodically, but I want you to get it that when somebody's giving you financial advice, you want them to have the right incentives. You got to ask the questions that we were talking about earlier in the show. I mean, Travis pointed out that you want to know where they earn their money and how they earn their money. And if you're not comfortable with that, you should go elsewhere. So Moneta, marvelous. Those of you who have a little more money than some of you. But the point is, I had you on the show because I know that you're an authority and you manage money for people who can afford the best. So that means that our listeners get the benefit of that expertise. So marvelous information. We'd love to have you back again, Travis.
Sure. Yeah, that'd be fun.
Yes. Good. We'll do it.
Thanks for having me.
This has been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with Tucker Allen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by Tucker Allen, your estate and elder law advisors. For more information, visit tuckerallen.com. Listen again next Saturday for another edition of Elder Talk with Tucker Allen. The choice of a lawyer is an important decision and should not be based solely on advertisements.